Welcome back, my dear students. In the previous lecture, I have discussed about the multi-time frame analysis on a price action chart. So in this lecture today, I am going to explain you about the short selling on a price action chart. You can also use indicator to look for sell signal to enter in the market. A short position is essentially the opposite of long position. When you enter a short position, then expect the price of the currency go down. The short currency means sell the currency on a price action chart and price will go down in the future. Now the bearish candle are completely engulfed the previous bullish candle. Then you find completely bearish engulfing candle on a top of a price action chart. Then you will notice that bearish engulfing candle are formed. Then you will trigger a short trade entry setup, that because selling pressure is high and price falling down at the moment, and it create a short trading signal. Let's see the real chart example. This is USD JPY 4-hour chart. You will notice that when the engulfing candlestick pattern has formed top of a price action chart, then you can see that the bearish candle are fully covered the previous bullish candle. This is the bearish engulfing candlestick pattern. And then you will place a short trade entry at the closing bearish engulfing candle and set the stop loss at least 3 pips above the engulfing candle high, and set the initial profit target at least twice size of stop loss using 1:2 risk and reward ratio model. Short-term trading for the perfect setup according to the technical analysis of your trading strategy. When perfect setup is achieved, then you can enter in the market. That means market trend are very important to set up. At first, you found the market trend and wait for the perfect setup to this market. So short selling is used in the stock and forex market to make a quick sale and to earn a decent profit in a short period of time. So not more today. Have a nice day. Goodbye.